webinar series where we cover useful and very interesting technical analysis story of Elliott waves. This time our topic is complex correction models with X waves, which is kind of intermediate level. In case you are new to the Elliott wave system, please feel free to see the archive of our video webinars, which are dedicated to Elliott waves as well, so you get to this topic educated. You can check our YouTube account or ask your account manager to provide you the links to previous webinars. As for the further developments, we are having webinars every Wednesday, so it would be great to see you on a weekly basis. So, coming up for today, first we are going to learn correction models with small X waves. Then we see how they differ from models with big X waves. In the end of the session, we will describe in details a specific model of expanding triangle, which is used rather rarely in forex trading, but still we would be able to see how these models are applied in forex trading. So if you're having previous forex trading experience, you probably know that any winning trading strategy won't be working sustainably without a proven and trustful partner. This is important to be educated not only in trading skills, but in trading conditions as well. So please have a look on features offered by Tickmill. If your broker doesn't provide you with such essentials as competitive spreads, segregated funds, and lack of free quotes, you'd better think of it once again. To start with, let me introduce to Mr. Ralph Nelson Elliott, who is famous for developing his general wave principle that he had described in his book Nature's Law, The Secret of the Universe. As you probably know, these rules tend to be universal, so they are covering not only the needs of financial market analysis, but still regarding to finance, we have the following outcomes. First, any trend move consists of 5 waves that include 3 impulse waves in trend direction and 2 correction waves, which direction is opposite to trend. We simply count them with numbers from 1 to 5. And the second law, once trend move is completed, correction follows. It consists of 3 waves, 2 in correction direction and 1 opposite to it. These correction are usually marked with the letters from A to C. Regarding deductions from Elliott's nature law, the first deduction is that suggested laws are universal to any kind of mass process. And second, all waves consist of smaller waves of same structure and are part of bigger waves themselves. On the given chart, you are able to see standard Elliott wave cycle. It starts with the impulse cycle, starting from the left part of the screen. When you can easily notice the upward move, which can be distracted into 5 parts. To visualize the previous rule that all waves have smaller waves of same structure, the smaller moves are marked subsequently with the smaller numbers in brackets. So you can see easily that impulse moves 1, 3, and 5 have impulse structures themselves, whereas correction waves 2 and 4 have according 3-wave structure marked with letters A, B, and C. So as I've already mentioned, we have discussed in detail the properties of impulse move 2 weeks ago. So if you need to reconsider these rules, please feel free to update your knowledge. Would be grateful if you use our webinars for it as well. And this time we are going to concentrate on the right side of the screen, where we have correction models. But before we come to today's topic, let's make a short wrap-up of what we have learned from previous webinar. Last Wednesday, we started with the description of zigzag correction, which has 5 to 3 to 5 structure, where waves A and C are impulses themselves, and wave B is a correction inside a correction model. Important notice regarding zigzag correction is its signal line. Signal line is marked as shown on the example chart of Australian to United States dollar, 1 hour time frame. The signal line connects the starting point 0 and the finish point of wave B. Once it is tested and broken, it marks the end of zigzag correction and confirms the continuation of main trend move. Second type of correction model is called flat correction. You are probably familiar with market condition of same name, flat, where the market is not moving in any exact direction for a certain period of time. As it's been described on Euro to United States dollar chart for our time frame. In red figure, you see selected price range, which is easily described as A, B, C correction. So flat has 3 to 3 to 5 structure. That means that waves A and B are correction waves and C is impulse. It was important to remind you on the properties of flat correction and zigzags, as these basic correction models form up many different kinds of complex models, which include X waves. So before we continue, I believe it's high time for you to understand the definition. So what is X wave by itself? This is a subsidiary wave in a complex correction model. X wave is always corrective and can take many forms, like a zigzag and flat, which we have recovered in memory just now. and also double zigzag, expanded flat, or combination and triangle, which we are going to see in details now. Let's see how it works on examples. We start with double zigzag correction, and as it follows from the correction model name, this correction unites two zigzags. Each of them has 5 to 3 to 5 structure, and each of these zigzags is connected by X wave. So what does it mean? Let me mark you with blue color the end of first zigzag, which is easily identified with thanks to its three-wave structure. And then let me mark the beginning of second zigzag, which has a similar structure and thus is easily recognized. The same goes here on the second example. So if you're not familiar with the concept of double zigzag, you would probably get a wrong view on the actual wave structure, because you would try to identify X wave as part of a bigger wave model. For example, you would be trying to count it as impulse move, but unfortunately it won't be recognized as um, impulse move. First of all, because it does the required properties. So it's important to understand that between two zigzag corrections of the certain configuration, we add one more correction model. So if you have got no previous experience of following double zigzags, it could be tricky to understand it sometimes, but once you see similar kinds of three-wave structures, it would be easier for you to identify it. What is good about double zigzag for your day trading is the line which connects two B waves. In fact, it is called BB signal line, and once the price tests the line and breaks above it, this moment in your trading marks a possible entry level in the trend direction. As you already understand, this correction move usually goes into direction which is opposite to the trend. So once the signal line is broken, you are able to enter the trade in the market direction, which is a safe bet for you. So here you see a similar concept of triple zigzag. In fact, it stays basically the same. It has several zigzags models which are independent from each other and are connected thanks to X waves again. The logics behind the double and the triple zigzags are the same. So let's learn what parameters do they have. First, usually it's a big model size. When the market goes into the face of double or triple zigzags, it is likely to expect that this currency pair is going to have a big move in terms of pips distance. The second property, which is likely for double or triple zigzag, is its volatility, or in other words, high speed of price change. If you look again at the zigzag structure, you are able to see that unlike flat models, the correction takes just little time and distance in pip understanding or points in comparison to main direction for the correction move itself. And the third idea is that the zigzags are likely to fit parallel channel. So if you are familiar with technical figures and you are used to building them on the chart, which is very welcoming from our side, I strongly recommend you to look once again on the price channels that are being built in recent time. So probably you would be able to identify in one of these channels double or triple zigzag corrections. Moving further, we are having combinations. There are 4 different types of double combination corrections, and as you will see soon, all of them are formed from the basic correction models, which we have learned last week. So the first type is a combination of zigzag and flat correction. It means that the structure of such combination is 5 to 3 to 5, which are parts of zigzag, followed by X wave, which has always a correction structure, so it means 3 again, and then 3 to 5 structure, which is required to be identified as flat correction. On the given scheme, you see the start of correction at the top of the screen. Zigzag, the first part of double combination, ends at the marked point and starts and is followed by X wave. After that, you see A, B, and then C. Flat correction move. In order to be identified, and just for reminder, you see that wave A has a 3-wave structure, so it could be first you may think that instead of double combination you are having double zigzag outcome. Here you see a signal line which you would have likely drawn if you thought this is a double zigzag instead of combination. But then you would be able to see that instead of providing a trend move, the price goes below the thought low of double zigzag structure. And at this point, when the low A is tested again, you are able to understand that you are seeing a double combination. So A, B, and C. At this point, I would like to share you an insight for understanding why it is very important to follow attentively different correction combinations. Even though it's unlikely that you're able to earn pips during the development of correction, as it's always thought to open trades presumably in the direction of the main trend and not into the correction direction. Learning corrections is very important, so you are able to understand what is the probable reversal point. Once you know the right answer, you are able to enter the trade at the right moment and not lose pips in trade direction already. If you are having any questions, please feel free to ask me about them. You can post your questions in the chat section in the left corner of the screen. I'm following this section attentively. The next idea of double combination correction combines zigzag and contracting triangle. That means that by the structure it starts with 5 to 3 to 5 zigzag, and then it has sorry, probably I've put the wrong picture. Yeah, so once the X wave is followed, instead of flat correction, you would be able to see a contracting triangle, which has a specific rule. Under normal development, each consecutive wave in a contracting triangle is smaller than previous. So if you are seeing a contracting, it's also known as a symmetrical triangle. It would be easy to identify it. As a rule, it doesn't break the previous bottom, which is the end of the start of a wave, until the figure is completed. In general, double combination zigzag and contracting triangle is even harder for interpretation in real time. The worst case scenario is that a wave of contracting triangle has a zigzag structure itself, so you can wrongly identify it as double zigzag. The adequate signal line for the current combination is B and E signal line at the end of contracting triangle, but unfortunately it's able to build it only in the end of this correction model build-up. Moving further, we are having few more types of double combinations. The third part of it is two flat corrections, which are connected with X wave once again. Sometimes it can be even a triple flat correction if you are following the idea behind X wave. You are able to understand that by its structure it could be flat correction itself. So regardless of the combination of waves inside of each flat corrections, the signal line which connects waves B and B is the most effective in this price model. This signal line gives a probable positive entry point at the moment when second flat correction is not having the place of wave A in contracting triangle. Finally, combination 4 is flat correction followed by X wave and then finished with contracting triangle. Personally, I see this correction model as one of most effective for entry purposes, as signal line B and B, which connects two parts of combination, is usually enhanced and confirmed with a signal line of contracting triangle itself. It says about signal line BD. Once the BD and BB signal lines are broken, it indicates the finish of correction model and reversal of the trend to the trend direction. In the case of this scheme, it's upside direction. Moving further, we are able to see that sometimes market develops a very extended type of correction models, and then we need to bear a triple combination. So the first possible outcome for triple combination is double zigzag, which we have described just before, plus contracting triangle. This model in process of being forming up may have different looks. First, you think of it as of double zigzag, then you see that it could be a type of double combination, for example, zigzag followed by flat correction. But as the price moves lower and lower, you would be able to understand this step structure as a triple triangle, triple zigzag. I find this model very useful again as the end of third zigzag followed by which is the beginning of contracting triangle itself, gives a very good understanding of possible stop loss level. As a rule, by its structure, each wave of contracting triangle is shorter than previous one. That means that in normal case, the low of wave A would not be broken once the correction price model is made up and finished. So in the case of such outcome, it could be very useful to enter the trade after the line of contracting triangle is broken. In the trend direction. And stop loss could be put just below the local bottom around the start of wave A. Another type of tribal combination unites the first type of double combination, that means zigzag and flat correction, which are followed by contracting triangle again. So the concept is similar to previous model. It's quite complex to be identified as each part of this triple combination is a bigger model itself. So you really need to spend a decent amount of time counting waves. But once again, as it's been completed, you're able to get a precise entry level for your next trade. So to wrap up, there are several kinds of double and triple models, which could be zigzags or combinations by itself. Each part of this combination is a specific kind of correction models, and they are interconnected with each other by X waves, which has a correction model as well. Well, at least this is easy to remember. So under such market conditions, correction models are followed by each other, but this is not so easy to indicate it, especially in real-time trading. One more point to discuss today is the concept of expanding triangle, as shown on the next slide. Expanding triangle is believed to be last of major correction models by popularities, as you could meet it not so often on the financial markets. The structure of expanding triangle is opposite to one of symmetrical triangle, which we have described earlier today. The length of each consecutive wave is higher than the previous one. By its structure, each wave inside the triangle has a correction structure by itself. So as a rule, they have three parts. Regarding the signal line, expanding triangle has got three of them. The first connects the start of Elliott wave figure and is called 0B. The second connects the ends of waves A and C. And finally, major signal line connects waves B and D. So the first rule is that none of waves A, B, and C should cross line 0B. Otherwise, it cannot be considered as a correct expanding triangle. The second rule is that none of waves B, C, and D should cross the second signal line AC, and that's especially critical for wave D. Finally, none of waves C, D, and E should cross the line BD. Once the last signal line, BD, is broken, you have got the signal to enter the trades. Let's see how it looks on the exact example. So on the chart, you will see that once the signal line is broken, you have got an opportunity to enter the trade into the right direction. The same as in case of symmetrical triangle, there could be exclusions when wave B or wave D is the shortest wave, which is not corresponding to the original idea behind expanded triangle, but that happens rather rarely. As a rule, you can meet expanded triangle in fourth or second correction wave in trend impulse. It also could be second or fourth correction part of terminal impulse. It can be a part B in zigzag of higher scale, or it can be part B or in flat correction of higher scale. To sum up, there are more correction models, which makes tricky to analyze markets by Elliott. They could be of big price change and duration. In fact, we are having just two types of impulse moves, like trend impulse and terminal impulse. At the same time, we are having 16 major correction models. As highlighted in today's session, many of correction models have got a really complex structure, so they have got lots of correction models of lower scale. So in case you would like to understand the price movements on Forex or any different financial market, you should be able to understand in which part of correction is the market going. Otherwise, you are risking to enter the trades blindly without clear understanding if the correction is already finished or it's not completed yet. What does it mean for your trading? If you are not having the described understanding of wave moves, you're risking all the time to have your stop loss triggered. Losing trade. Analyzing previous wave models provides an insight on possible following models, and that gives positive potential to trading strategy. That is the end for the major part of webinar. Now we are going to have a question and answer series. If you have some, please leave them in the chat box, and we are going to discuss them in details. So any questions are welcome. Once you test these tools on your account, it's high time for you to check its performance live. And that is the right time when Tickmill can help you. The broker offers you a classic account where you do not have to deposit as much and where the trading conditions are nevertheless great. With Tickmill's classic account, you can enjoy trading with quite a lot spread that starts at 1.2 pips for euro-dollar. In addition to this, there are absolutely no commissions attached to this account, which is quite an important feature for the beginners, as it lets them to focus primarily on the market without spending time on calculating the profitability due to the commissions. To sum up, it was an quite intense in terms of information session, as we have covered multiple number of correction models. I hope that throughout the time you would be able to integrate them in your trading and thus have a better results. Next Wednesday, we are having a final part of our webinar series, Elliott Waves from A to Z, where we are going to discuss a certain kind of trend move, which is called terminal impulse. As for now, I thank you for the attention and wish you profitable trading ahead. See you on next Wednesday. Bye.